Hi, and welcome to the Stock Market Palantir. Don't forget to subscribe and drop your comments below. All right, let's see the analysis.
24.79%. That is the exact number on the screen in the after-hour session on February 26, 2026. Block Incorporated, ticker symbol SQ, surged to $68.05.
Right, and that violent repricing didn't exactly happen in a vacuum. It followed a massive spike in off-exchange activity and what looks like a gamma squeeze that had been building up for weeks in the options market.
It is the single clearest signal we've had in years, frankly. The market is finally waking up to the reality of Jack Dorsey's intelligence-native pivot. We are looking at a company that just smashed expectations, delivering an adjusted EPS of 65 cents against the consensus of, 26 cents? I mean, that isn't just a beat. That is a totally different stratosphere.
Or alternatively, we are looking at a mechanical repricing driven by dark pool liquidity and a ruthless slashing of the workforce that sure might look great on a spreadsheet today, but completely guts the company tomorrow.
Well, that's exactly what we are parsing out today. The central question is whether this massive surge represents a fundamental validation of a brand new business model, or, as you say, if it's just high-risk financial engineering masquerading as innovation. I'll be arguing that this is a visionary transformation. They are using AI to replace headcount, proving Block can finally balance high growth with the Rule of 40 profitability metric.
And I will be taking the stance that this price move is heavily distorted by market microstructure, wholesalers, dark pools, you name it, and that cutting 40% of your staff is a massive operational risk, not some sustainable productivity miracle.
Let's dive right into the Q4 2025 performance, because I think you're confusing engineering with evolution here. This report is a watershed moment. For the first time, Block has proven it can balance that high growth with the Rule of 40. Gross profit grew 18% year over year to $2.66 billion. In December alone, just that one single month, they cleared $1 billion in gross profit. That is historic. And the 40% reduction in workforce, going from 10,000 down to 6,000 employees, it's an offensive move.
Offensive?
Yes, offensive, not defensive. It fulfills this intelligence-native mandate. Dorsey has been clear that AI agents can replace human labor to achieve higher product velocity. They are pointing to a 2026 guidance of $3.2 billion in adjusted operating income with a 26% margin. You don't hit those numbers by keeping legacy bloated structures in place. They have unlocked operational leverage.
Look, the numbers are flashy. I'll absolutely grant you that. But we have to talk about the how. You mentioned the pivot, so let's be precise about what that pivot actually entails. This isn't just a strategy shift. It is a demolition of the organizational chart. You're talking about firing 4,000 people.
To flatten the structure, yes?
But firing 4,000 people incurs $450 to $500 million in restructuring charges. That is $500 million literally just to show people the door. I see the margin expansion, short, but I also see a company where top-line growth is absolutely stalling. Total revenue only grew 3.6%. That is, frankly, anemic for a supposed growth stock. When your revenue grows at 3% and your earnings grow at 150%, you aren't growing the business. You are cutting your way to profitability.
I disagree with the characterization that it's just cutting.
And honestly, the market reaction feels entirely amplified by the plumbing of the market rather than pure fundamental sentiment.
I really disagree that it's just plumbing. But go on, lay out the option side.
You have to look at the derivative holdings. Right before this earnings release, Simplex Trading increased their call positions by 67,000%. That is not a typo, 67,000%. That suggests massive front-running or an insane volatility bet that just happened to pay off. It smells exactly like a gamma squeeze. Market makers are forced to buy the underlying stock to hedge the calls they sold, and that drives the price up artificially.
Or it suggests that sophisticated capital saw the writing on the wall. I mean, they saw that the consensus estimate of 26 cents was wildly pessimistic given the cost cuts.
Maybe, but when you combine that options flow with the fact that 36 to 40% of the volume is executing in dark pools, it really makes me question the stability of this new price floor. Well, let's put the plumbing aside for a second, dig into this intelligence-native restructuring, because you seem to think it's just a buzzword. I am convinced this is the future of enterprise efficiency. And it's not just me. Analysts from Oppenheimer and RBC raised their price targets to $95 explicitly because they are buying into the AI efficiency thesis.
Analyst upgrade momentum. That's what they do.
But think about what Block is actually doing fundamentally. They are transitioning from a labor-heavy model to one where agentic tools handle the heavy lifting. This allows for much smaller, tighter teams. Dorsey is betting that a team of 6,000 people armed with advanced AI can out-execute a team of 10,000 without it. And hitting the rule of 40, where your growth rate plus your profit margin exceeds 40, it validates that the strategy is working right now. Achieving the rule of 40 by decimating your staff is a really dangerous game. You call it agentic tools, I call it an unproven experiment at scale. We aren't talking about automating a couple of customer support chatbots here. We are talking about replacing 40% of the intellectual capital of the firm. That creates immense internal disruption. Institutional knowledge walks out the door, the company culture phrase, and, again, let's look at that revenue. Up 3.6%? If these AI tools are so incredible at creating product velocity, why isn't that translating into double-digit top-line revenue growth?
Because the quality of the revenue is changing. They are deliberately shedding low-margin activity for high-margin engagement. Just look at the Cash App gross profit. It is up 24% year over year. They are monetizing their base significantly better, not just chasing growth for growth's sake.
Right, but is that sustainable? You can only cut costs once. Eventually, you actually have to sell more product to new people. And that brings me right back to the market mechanics. You're celebrating this price surge, but I want to talk about who is actually doing the buying.
I'm very happy to talk about who is buying. It is what we call smart money. We aren't just seeing retail speculators or meme stock traders here. EP Wealth Advisors increased their position by 327%. The state of Tennessee Treasury increased their stake by 34%. These are institutional long-term holders. Plus, you have the passive giants, Vanguard, BlackRock, providing a massive, stable floor. This is institutional accumulation.
It is institutional, sure, but let's look at where they are trading. You mentioned the lit price on the NYSE earlier. But the real volume, the actual market-moving volume, is happening in the dark.
That's standard for literally any high-volume equity today.
Not to this extent, though. We are seeing massive volume in the UBS ATS, which is the largest dark pool globally, and an Intelligent Cross. Intelligent Cross uses this near-match AI logic to minimize market impact. What that means is the big whales are actively hiding their moves. And then you have internalization. Wholesalers like Citadel and Virtue are matching retail orders internally. The $68 you see on your screen is just the exhaust fumes left over after the real volume has been processed in the dark.
Which ensures liquidity. It prevents massive price dislocation during the earnings reaction.
It also masks true market sentiment. Look at Optiver. They are a massive market maker. They increase their call position by 50%, yeah? But they also increase their put position by 130%. They are hedging volatility. Block has a beta of 2.67 right now. These guys aren't betting on Jack Dorsey's grand AI vision. They are betting on the stock thrashing around violently. That is a completely different thing than fundamental conviction.
Look, I think you're being overly cynical about the mechanics, which is fair to point out, but you are completely ignoring the fundamental shift in the business model, specifically regarding Cash App. This is no longer just a peer-to-peer payment tool. It is becoming a bank.
A bank without a charter?
A primary financial hub. And the data proves the strategy is working. Inflows per active user hit $1,410 in Q4. That is up 12% year over year. That is the holy grail metric for a fintech. It means people are depositing their actual paychecks into Cash App. They have 9.3 million users using it as their primary account now.
And yet, monthly transaction actives only grew by 3%.
But the monetization of those specific users is skyrocketing. Their financial solutions division, which includes the lending products, grew 51% year over year. They are successfully cross-selling borrowing products to their existing base. That is exactly how you unlock those high margins.
Which is exactly what worries me. You have slowing user growth. The hyper-growth phase is essentially dead at 3%. So they are forced to squeeze the existing users harder just to show any growth. That financial solutions growth is driven almost entirely by Cash App Borrow.
They are lending money to a subprime consumer base in a very shaky macroeconomic environment.
It's integrated closely with Afterpay. It's data-driven lending. They have vastly better visibility into those users' cash flows than any traditional bank does because they see the exact inflows and the peer-to-peer transfers in real time.
Visibility doesn't mean repayment ability. If the economy turns, that credit risk sits right on Block's books. They are pivoting from a low-risk fee-based model to a high-risk lending model just to keep the growth narrative alive for Wall Street. It is a classic trap for fintechs when their user acquisition stalls out.
I disagree that it's a trap. It's the natural evolution of a mature financial ecosystem. And speaking of ecosystems, we have to talk about the wild card here, the proto division.
Oh, the Bitcoin mining rig.
It is more than just a rig. It is core infrastructure. Block is building a modular mining unit that has a 10-year lifespan. Compare that to the standard industry hardware, which lasts maybe 3 to 5 years before it's obsolete.
Why is a payments company building heavy hardware?
Because the current market is essentially a monopoly. Bitmain controls 80% of the mining hardware market. Block is disrupting that with the proto-rig. It has tool-free hashboard upgrades. You can pull out a specific board and replace it without having to scrap the whole unit. It reduces overall upgrade costs by 15 to 20%.
And it consumes 12 kilowatts per rack. It is incredibly energy intensive, it is capital intensive, and it is a massive distraction from their core software business.
It aligns perfectly with their mission of decentralization. And they have the proto-fleet software to manage it all. They are deploying this at Core Scientific's facilities right now. It is a live, working proof of concept.
Sure, it aligns with Dorsey's personal passions, but as an investor, they already hold over $600 million in Bitcoin on the balance sheet. That ties the stock price directly to crypto volatility. Now they are manufacturing hardware in a highly competitive industry where margins are notoriously razor thin. I mean, you just finished telling me the story of Block is about AI efficiency and high margins. Manufacturing heavy industrial mining equipment is the exact opposite of a high-margin, light-touch AI business. It's a total contradiction.
It's not a contradiction. It's diversification. It disrupts the Bitmain monopoly and integrates the company much deeper into the Bitcoin network, which they view as the native currency of the internet.
Which the market views as a liability. Investors want clarity. They want to know, are we buying a software company achieving 26% margins or a hardware manufacturer holding a ton of volatile digital assets? The proto division just muddies the water.
I think it actually clarifies their long-term vision. They aren't just processing payments anymore. They are building the underlying rails. But let's step back to the core financial picture, because you keep going back to the risks, but the market is looking at the execution. December 2025, $1 billion in gross profit in a single month. That is the metric that matters most. It proves that despite the layoffs, despite the massive restructuring charges, the machine is printing money.
It proves they had a really good month. But let's look at the guidance again. They are projecting $3.2 billion in adjusted operating income for 2026. That relies entirely on these theoretical AI efficiency gains materializing immediately. If the AI integration hits a snag, or if the remaining 6,000 employees just burn out because they are doing the work of 10,000, those margins will compress instantly.
That is exactly why they are calling it intelligence native. It isn't about the remaining people just doing more manual work. It's about the agents doing the bulk of the work.
Agents is a fantastic buzzword for an earnings call. But until I see sustained revenue acceleration, not just margin expansion achieved by firing people, I remain highly skeptical. And the market microstructure tells me I'm not alone in that. The volatility, the massive options hedging by market makers, the dark pool activity, it all suggests that the market sees this jump as a trade, not a long-term investment.
Well, the fact that Oppenheimer and RBC are maintaining outperform ratings suggests otherwise. They clearly see a fundamental rewriting. The stock was trading at a PE of around 13 before this jump. That is historically low for Block. It was priced for failure. Now it is finally being priced for execution.
A forward PE of under 10 is low, I grant you that. But it's low because the market is heavily discounting the risk of this massive transition. You don't get a single-digit multiple on a high-growth tech stock unless the market is deeply worried. And with the consumer lending exposure and the Bitcoin volatility on the balance sheet, there is plenty to worry about.
Risks exist, absolutely, but the rule of 40 is the North Star for software. They hit it. They exceeded it, actually. The combination of 18% gross profit growth and the margin expansion is undeniable. And the Cash App ecosystem is sticky. 9.3 million primary users don't just up and leave their bank account overnight.
They might if the lending products turn predatory or if the customer service degrades because they just fired 40% of the support staff.
Square AI is handling the support. That's the entire point. The mid-market sellers on the Square side, which, by the way, grew GVP by 12%, they are using these AI tools for inventory and accounting right now. Block is embedding the intelligence directly into the product.
We will see if the mid-market merchants agree that an AI chatbot replaces a dedicated account manager. Square is facing intense competition from Shopify and Stripe. Growing GVP by 12% is decent, but it's certainly not world-beating.
It is incredibly resilient in a tough macro environment.
Resilient? Perhaps, but worth is 25% overnight repricing. That still feels like a squeeze.
Let's bring this to a point then. We are looking at a company that has fundamentally changed its DNA over the last 12 months.
I agree with that. The DNA has absolutely changed.
Right. They have successfully pivoted from a hardware payment processor to a high-margin, AI-driven ecosystem. The Rule of 40 achievement isn't some fluke. It's the result of strict discipline. The $1 billion monthly gross profit milestone proves the financial model is working at scale. The intelligence-native structure is not just jargon. It is the future of enterprise efficiency, and Block happens to be the first major fintech to fully embrace it.
And I maintain that this valuation surge is heavily driven by opaque market mechanics, dark pools, internalization, and a massive gamma squeeze on call options. The efficiency you're talking about is largely a result of aggressive cost-cutting that introduces significant operational risk. Slashing 40% of the workforce while pivoting to become a primary bank and a Bitcoin miner simultaneously is a high-wire act. Investors really need to decide if they are buying a fundamental growth story here or just riding a temporary wave of liquidity.
Well, it sounds like we both agree on one core thing today. This is a company in radical transition.
Absolutely. Whether that transition leads to the promised land or a total operational breakdown remains to be seen.
We will certainly be watching that 26% margin target very closely in the coming quarters.
And the revenue growth. Don't take your eyes off the top line.
If you like this video and want to watch more content like this, don't forget to subscribe. Thanks for watching. See you.